Everybody's waiting out to see the GDP fine print. So let's take the discussion forward. And what is the street penciling in, and what is Nomura actually penciling in? Let's try and find out that. We are being joined by Aurodeep Nandi, India economist at Nomura. Hi, good morning, Mr. Aurodeep. Thank you so much for your time. First up, talking about your estimates then, Aurodeep, what we believe is that your forecast stands at 5.8% for Q3 FY25, and that's below the street estimates, while the street is expecting a number above that 6% mark. Help us understand that what are you factoring in, and why is your number different from the rest?
Well, one of the things that we do is we have something known as NITE, which is Nomura India Growth Thermometer, where we take in all the high frequency indicators, compress it down, and figure out how much is sequentially, how much is growth picking up in a particular quarter once you seasonally adjust it. And that number, what we are getting looks like a sub 6, suggests a sub 6% growth. Now, if you look at the sort of buckets one by one, on the consumption side, it's let me get this cleared up. 5.4% in the previous quarter was a low. So I think everyone is pretty much agreed that things should pick up from the prior quarter. Now, that said, within the consumption side, it's a mixed bag. For instance, passenger vehicle sales did well, two-wheeler sales down, tractor sales did well, diesel sales well. But then, you had aviation cargo or GST collections on the lower side. Investment and industry indicators, if you look at the overall trend across quarters, it's not been necessarily a great quarter out here. Public capex has picked up, but it's very curious because October and November capex growth, which has been quite low for now after the election kind of freeze, was supposed to pick up this quarter. October, November remained quite weak, and then December we saw a sharp increase. So I think taking all these factors into account, what we see in terms of the components of growth is that on the demand side, right? So on the GDP side, consumption we expect will incrementally improve. Investment growth we expect will remain stable. We expect a recovery in government spending, but imports have picked up quite a lot compared to exports. So the net exports minus imports is going to be a drag to GDP side. On the GVA side, which is the supply side, agri-industry services, this is going to be a good quarter for agriculture, right? So Kharif production has been really good thanks to great rain. So we expect a strong number coming on the agricultural side. Industrial side, you can have a look at the kind of corporate earnings that we've got. You can look at the way industrial production growth has been. Doesn't really inspire too much confidence. It's been kind of tepid. On the services side, we expect stable growth for construction, for financial services, for real estate and professional services. But trade, hotel, transport, communication, we expect will remain tepid. So that's sort of broadly where we are seeing growth in this quarter.
Let's delve a little bit deeper, and I would like you to give your sectoral view as well over here, how you see the various constituents which you did touch upon right now. Everything from realty to services, hotels, transport, etc. And of course, agri and industrial growth as well. How are you penciling in them to perform? Whether you see some weak performance coming in, or you think they're going to be strong contributors this time?
So agri, I think, as I said, definitely is likely to be a strong contributor. We have penciled in around 4.5% growth, which is pretty good for agriculture. For the industrial side, I think the thing that sort of worries us a bit is that the corporate results that have come out remain cautious, and that's been the theme, in fact, for the past, not just this quarter, but also the prior quarter. And also industrial production growth has been relatively underwhelming. On the services side, look, on one side, the government spending has picked up this quarter. So the public administration component should pick up. Construction growth, we expect, will remain stable. Financial services, real estate, professional services, this block, we generally look at retail credit growth. It's not sharply picked up. It's still sort of very sedate. But nevertheless, we are penciling in steady growth. Trade, hotel, transport, communication, typically, it's linked to consumption in the economy. And that side, we think that it may remain tepid. On the demand side, so this is supply, agri-industry services. On the demand side, consumption, investment, government spending, net exports. Consumption, we expect, will pick up now. Yes, this has been wedding season and festive season, etc. But compared to what one would have expected, at the start of the quarter, where people were thinking, oh, people are buying a lot this quarter, the indicators we see is it's a very mixed bag for consumption. Some have done well, some haven't. Urban consumption growth is still facing headwinds. Investment side, if government spending in infrastructure has been fine, then you should get stable investment growth. The worry is actually on the net export side, because the way we see it, imports have picked up more than exports, so that will be a drag to the overall equation.
A lot's been happening with respect to the global developments, and there are proposed US trade tariffs as well. And you have been also mentioning that it's the negative net import data, negative net export data rather, which has been hampering the growth of the GDP. Help us understand that. How are you seeing the whole situation pan out, and is this overhang likely to continue, and this negative number is likely to continue going ahead as well?
I mean, look, we are in very uncertain times as far as both in terms of sort of the impact of the tariffs, right? So there's a positive and a negative side. The negative side is pretty obvious. If there are higher tariffs, then, and especially with US being the top market for India, it's going to be an issue. The positive side is that if there is a full-blown trade war with US and China, a lot of companies could end up shifting their supply chains to India, which would then be a sort of a medium-term positive. So there are a lot of uncertainties on the trade side. One thing which has been good so far for India has been that the services export growth, driven not just by IT but also by professional services, has been pretty strong so far, and that's been kind of the balancing factor in all of this. I mean, look, broadly, we think we aren't all that bullish on growth. We have 6% growth in FY25, and in fact, we have 5.9% in FY26.
So I'm just wondering, Aurodeep, how will it all translate into what the RBI is going to do? What in terms of a rate action are you anticipating further this year?
Cut. So overall, we expect the RBI to deliver 100 basis points of cumulative cuts. They've delivered 25 basis points already. We expect 75 basis points more. In fact, we've been calling for a pivot in monetary policy for quite some time. In fact, from October onwards, if you look at our reports, we've been saying that, look, growth isn't as strong as it's being wanted. This was a time when RBI's official growth forecast was over 7%, and we said that, look, this is looking unlikely. The RBI inflation isn't as big a problem as RBI is making it out to be. Growth is slowing cyclically, so let's pivot. And I think that realization has happened now. So there has been a pivot of monetary policy, and we expect 75 basis points more cuts this year.
This we'll let you go on that. Thank you so much for taking the time out and speaking with us, and help us understand that what are you factoring in when it comes to the GDP data.
If you like this video, then like, share and subscribe to ET Now.